Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Workers' remittances to Sri Lanka recorded another strong performance in April 2026, reinforcing their role as the country's largest source of foreign exchange. According to the latest data released by the Central Bank of Sri Lanka, remittance inflows increased by 19% year-on-year to $767.9 million in April. This marked the fourth consecutive month of exceptionally strong remittance inflows despite economic uncertainty linked to the ongoing Middle East conflict, where a large share of Sri Lankan migrant workers are employed. The April inflow also surpassed the previous April record of $646.1 million recorded in 2025, making it one of the strongest monthly performances on record. However, compared to March 2026, remittances declined by 6.1% from $814.7 million, reflecting seasonal variations in transfer patterns. The April 2026 figure now ranks among Sri Lanka's strongest monthly remittance inflows, following the records achieved in December 2025, December 2020 and January 2026. Meanwhile, cumulative remittances for the first 4 months of 2026 rose to more than $3.06 billion. This reflected a strong year-on-year growth of 24.5% and marked the highest January to April performance in the country's history. With export earnings and tourism facing external pressures, remittances have once again strengthened their position as Sri Lanka's single largest source of foreign exchange. The inflow continued to provide critical support for external reserves and broader macroeconomic stability. The strong performance in 2026 follows a record year in 2025 when full-year remittances climbed to $8.07 billion. This represented a 23% increase from the previous year and exceeded the earlier annual record of $7.24 billion recorded in 2016. According to central bank data, the recovery in remittance inflows has remained strong since the sharp decline experienced during the 2022 economic crisis. During that period, remittances fell by 31% to a 12-year low of $3.78 billion amid severe foreign exchange shortages and increased use of informal transfer channels. The recovery began in 2023 when inflows surged by 57% to $5.96 billion, marking one of the strongest post-crisis recoveries on record. Momentum continued in 2024, with remittances rising by a further 10.1% year-on-year to $6.57 billion. The increase was supported by higher overseas employment migration following the economic crisis. Although overseas departures eased slightly in 2025, remittance inflows continued to increase, indicating higher average transfers per worker. Historically, Sri Lanka's worker remittance averaged around $7 billion annually between 2014 and 2018, further highlighting their long-standing importance to the national economy. Sri Lanka's fiscal position strengthened significantly during the first 2 months of 2026, with the government recording a sharp increase in the primary surplus and a turnaround in the overall budget balance. According to the latest data released by the Central Bank of Sri Lanka, the government recorded a primary surplus of 545.42 billion rupees during January and February 2026. This reflected an increase of more than 66% compared to 328.45 billion rupees recorded during the same period last year. The improvement was mainly supported by stronger revenue performance and restrained expenditure growth. Meanwhile, the overall budget balance recorded a surplus of 169.71 billion rupees compared to a deficit of 86.62 billion rupees in the corresponding period of 2025. This marked a turnaround of nearly 296% year-on-year. Total revenue and grants increased by 35.5% year-on-year to 1.03 trillion rupees during the first 2 months of the year. The increase was mainly driven by strong growth in tax revenue. Tax revenue rose by 35.8% to 959.9 billion rupees, while non-tax revenue increased by 32.8% to 71.26 billion rupees. At the same time, total expenditure and lending minus repayments increased by only 1.6% year-on-year to 861.45 billion rupees. Recurrent expenditure rose marginally by 1.5% to 802.91 billion rupees. Capital expenditure and lending minus repayments also increased by 4.2% to 58.53 billion rupees. The stronger fiscal performance indicates the continuation of fiscal consolidation efforts supported by improved revenue mobilization and controlled expenditure growth. This was achieved despite ongoing reconstruction spending following Cyclone Ditwa and emerging global energy-related risks linked to the Middle East conflict. The improved fiscal performance also comes as Sri Lanka moves closer to receiving the next tranche of International Monetary Fund financing following the staff-level agreement on the combined 5th and 6th reviews under the Extended Fund Facility Program. However, external pressures remain elevated. Higher global energy prices and reconstruction-related expenditure are expected to place additional pressure on public finances during 2026. The IMF and rating agencies have also continued to stress the importance of sustaining revenue mobilization, maintaining cost-reflective pricing mechanisms, and containing fiscal risks in order to preserve recent gains in fiscal consolidation. Private sector borrowings from the banking system accelerated sharply in March 2026, reflecting strong economic activity and increased demand for credit ahead of the festive season. According to the latest data released by the Central Bank of Sri Lanka, total outstanding credit to the private sector increased by 258.4 billion rupees month-on-month to 10.7 trillion rupees in March. This marked the second highest monthly increase in private sector credit recorded over the past 12 months. The highest monthly increase during the period was recorded in November 2025 when private sector credit expanded by 263 billion rupees. Meanwhile, the lowest increase was recorded in January 2026 following Cyclone Ditwa before credit growth recovered in February and accelerated further in March. The central bank stated that total private sector credit expanded by 2.5% month-on-month in March. On a year-on-year basis, private sector credit growth accelerated to 27.1% compared to 26.4% recorded in February. Lending from domestic bank units accounted for the majority of the increase. Outstanding credit from domestic banking units rose by 259.9 billion rupees to 10.14 trillion rupees in March. Year-on-year growth in lending from domestic banking units increased to 29.3%. In contrast, credit from offshore banking units declined marginally during the month to 556.2 billion rupees. On a year-on-year basis, offshore banking unit credit contracted by 2.7%. Meanwhile, net credit to the government declined slightly to 8.13 trillion rupees in March. Year-on-year, government credit contracted by 2.7%. Credit extended to public corporation and state-owned enterprises also continued to decline. Outstanding lending to the sector fell by 26 billion rupees month-on-month to 411.2 billion rupees in March. On a year-on-year basis, lending to public corporations contracted by more than 31%. In its annual economic review 2025, the central bank stated that improving economic activity, stronger demand conditions, and reconstruction efforts following Cyclone Ditwa are expected to support continued private sector credit growth during 2026. However, the report also warned that spillover effects from the Middle East conflict could weigh on economic activity and reduce global demand for Sri Lankan goods and services. The central bank noted that overall credit growth is expected to remain moderate during 2026, with a possible slowdown towards the latter part of the year. The report further stated that credit to the public sector is likely to moderate alongside continued fiscal consolidation and structural reforms, including the restructuring of state-owned business enterprises. The central bank also indicated that further expansion in the banking system's net foreign assets is expected, supported by high foreign exchange inflows and official reserve accumulation. Meanwhile, the central bank reaffirmed that monetary policy decisions would continue to be guided by data and forward-looking assessments while maintaining clear communication to support price stability and public confidence. The World Bank says Sri Lanka's ongoing and planned trade reforms could improve competitiveness and increase household consumption, particularly among lower-income groups. According to the World Bank's April 2026 South Asia Economic Update, household consumption could increase by around 3.1% as trade reforms are gradually implemented. The report stated that the strongest benefits are expected to flow to lower-income households. The World Bank noted that planned import duty reductions would be most significant in emerging export industries, including food and beverage manufacturing, as well as rubber and plastic products. In line with the government national tariff policy, Sri Lanka is planning a 4-year reform program to fully eliminate PAL and cess para tariffs by 2029. The report stated that the removal of these two major para tariffs would amount to a 9 percentage point reduction in import-related charges. However, the World Bank also cautioned about the continued use of other para tariffs, particularly the Ports, Airport Development Levy and the Commodity Export Subsidy Scheme. According to the report, relatively high import duties and trade barriers continue to negatively affect Sri Lanka's economic progress and competitiveness. The report also highlighted several risks facing the external sector. Sri Lanka remains highly exposed to global energy price shocks, which could increase import costs and place additional pressure on inflation, fiscal balances, and the current account deficit. The World Bank further warned that volatility in global energy markets, particularly linked to tensions in the Middle East, could weaken macroeconomic stability. Climate-related risks were also identified as a major concern. The report noted that events such as Cyclone Ditwa demonstrated Sri Lanka's vulnerability to extreme weather conditions, which could disrupt agriculture, damage infrastructure, and slow overall economic activity. The World Bank additionally highlighted risks linked to possible disruptions in the Middle East, which could affect workers' remittances and tourism earnings. The report stated that the economy continued to face the long-term effects of the previous crises, including shortages of skilled labor caused by outward migration and the under-execution of the capital budget. While the government improved its primary surplus during 2025, the report noted that Sri Lanka continued to face pressure in managing debt obligations and implementing state-owned enterprise reforms. The World Bank emphasized that although the economic recovery is underway, sustaining long-term growth could depend on structural reforms and managing the impact of rising import bills on the current account deficit. Let's take a look at this week's Treasury-bill auction results.
With the recent Treasury-bill auction, the 91-day T-bill rate stands at 8.13%, down by 7 basis points. The 182-day T-bill rate stands at 8.23%, down by 1 basis point, and the 1-year T-bill rate stands at 8.49%, down by 3 basis points compared to the previous week.
Thank you for watching. We'll be back next week.